Hello and welcome to Chartbusters. Well, the 18,000 mark has been breached early this morning. It took us a few months. The last time we hit this level was on April 5th. Currently, from the highs of the day, we've seen some bit of profit taking. But let's see where we go from here. Hey, Mangla.
Hi, Nigel. It is important to see where we go from here. But the journey has been such a long one, such a volatile one. We've seen a lot of stocks move around. In just the last 6 months, we've seen a big jump in all the auto stocks, in the FMCG stocks, and a big underperformance coming in from IT, pharma and metals. But as we do that, let's also cut across to the finance minister who's speaking at an event.
And the leadership of the Prime Minister, which together gave us the guidance, but also the tenacity, endurance, but also the spirit to fight, all of which I think has resulted in getting India where it is today. And in this, the question that you asked as to what held you back and what made you remain where you are in taking the call, the way we've taken, rather than the way loosening the purse and throwing money as though that will give the solution. I think the question is for them to say as to why they thought that was the blanket solution. Because logic or reasoning will tell you that once you are consulting different sections and they have voiced their concern, each differing from the other, or slightly at least differing from another, the solution had to be given to each according to the way they would want. And therefore we thought if the consultations are ongoing, and if consultations are coming up with concrete suggestions, each to his comfort, each section to their comfort, we thought that's the best way. So it is one thing to listen to advice of, let's say, very respected economists. I have no criticism to offer to them. They had their viewpoint from the point of view of the theory as they teach. But ultimately, I think each country had its own way of solving its problems. We've come out well, and thanks to the credit of the people and their literally the confidence that you talk about, Maria Angelo. They acquired the confidence. They thought it was for them to fight through, and the government did stand by them.
So let me take the point I made a little bit earlier. India's economy getting to where it is now, being the 5th largest economy. Which are now going to be the big focus areas for you to move India from being the 5th largest economy further up the ladder, maybe to the 3rd? Because in power purchase parity, we already are the 3rd. Clearly, we're headed for growth, bigger growth than most others at this moment, and that is quite clear. But the question will be about the balance within the economy, which portions get more attention and which ones get moderated. Because a challenge has been thrown out by the Prime Minister for India to be a developed nation by time we turn 100. And I think it's a wonderful way to look at India. So where is your big focus going to be now?
I think the driver would be engaging the youth power. So sectors which have great potential for engaging them, and when I say youth, I mean youth with all sets of skills. You can start from the bottom to the top, which speaks about frontier technology related skills, innovative skills, or STEM sciences skills, or it can just be very, at the bottom, skilled, not so skilled workers. So when you're planning for the Indian economy for the next 25 years, which we are calling Amrit Kal, and PM has highlighted champion sectors will be the ones with which we start off. But the first litmus test would be how would it benefit the workforce? Some at the leadership level and some at the bottom, or some in the middle. But people come out of universities, colleges, schools with different sets of skills. All of them need prospects for the future. And in that prospect is where the next 25 years is going to be geared. So that will be the testing measure. But otherwise, of course, I will stretch the argument a bit more. not so much to make it a tenuous argument, but it is a fact that 3-4 years ago, when in Davos all of us heard Industrial Revolution 4.2, Web 3, IoT, artificial intelligence, I'm happy to say that India in the last 3-4 years has actually built its capacities on these. Today, if India is showing the way on digital payments, digital influence into your medical practice, setting up of 75 digital derived centers of learning, setting up of 75 digital banking. 75 is because we want to also remember that it happened in the 5th year of independence. The digitization, the rapid influence of digitization, even in areas like agriculture. So we've shown the way since after what we heard in Davos. So that is, I think, the kind of direction. Move it more towards digitization, even more, and also make sure the workforce participation is at its maximum.
So let me take two comments, two of the things you mentioned. One is labor policy. How do we get more people sustainable economic opportunities? How do we ensure that the system is fair and encouraging of jobs? Because we have had this challenge, it's probably the single biggest challenge for us as a nation is to ensure the standard of living for all Indians. And I would imagine more than anything else, that's one thing we have to address. But of course, we have to address it through growth. That's the only positive way to do this. So is there a tweak or a change required in our policy to encourage more hiring and better compensation and better work conditions?
Well, if I take the example of the PLI, the Productivity Linked Incentive Scheme, one of the things was, as much as we looked at every addition to the production, every unit in addition that you produce, and at that scale, we were also looking at what will be the impact on our labor force. And when we are talking about MSMEs, that's large, but when we are talking about MSMEs on the other end of the spectrum, we are looking at in-situ solutions for MSMEs wherever they are, because locally, they are the ones who give training, they are the ones who are going to be able to employ locally as much as collectively, if you think, as the large-scale units. So the policy has necessarily underlined the importance of labor and engagement of labor, and that's where we think we are pushing technology, digitalization, as much as we are pushing opportunities for work.
You're right. We will need to work on both ends. On the top end, we need to become global leaders, for sure. There's not even an option for many of our sectors, and we have some big leaders here, sitting here, who run global companies, who have demonstrated what India can do. Indians themselves have already led so many global enterprises, so individual capability is not an issue. So it is probably the tweak that's required, systemic, is also in the work environment, I think, on both. The other comment you made, or let me stick to PLI for a moment. Chinese companies have gone and done things in manufacturing without fear of actually having made losses, because it, in one way or the other, gets made up by the government system, whether it's through hidden subsidies or through loans which continue to be non-performing loans. As you know, their percentage of non-performing loans is about the highest in the world. And do you believe the PLI will compensate enough for a whole variety of Indian businesses now to be globally leading? Because it has to be globally competitive first to become globally leading. Do you think that scheme, because the result is yet to be seen, we've only got one company that's been currently cleared for the scheme. Hopefully many more will get cleared in the coming weeks and months. Is that enough, or is there other things we need to do to remove some of this fear people had of getting into manufacturing over the last decade or so? We saw a little bit of a climb, then we saw a bit of a decline, as you know. Now, and it is necessary. Of course, service is wonderful, but we cannot only be a services nation. We have to have a good spirit of agriculture, services, and manufacturing.
You're right in saying we'll have to see how it goes on the PLI because only one has come and so on. But equally, I'm hearing a lot more companies who are moving out of China wanting to come because they find the policies a lot more attractive, not just the PLI, but overall the ecosystem is now far more facilitative of such companies coming out to locate themselves in India. If that is one of the things. The second, I think, no policy can be the end to itself. It's not as if we've given a solution and that's the end of the story. It keeps evolving as we go on. So that applies even to those industries which are coming into the sunrise sector for which we've given the policy support through an incentive. But if it's not sort of impertinent to say this now, I equally would want to know from the Indian industry, what is it that they are hesitant about even further? Since 2019, when I've taken charge of the finance ministry, I've been hearing, though the industry doesn't think it's conducive. All right, bring the rate down. All right, tax rate was brought down. And I keep defending industry, private sector, where even provocatively people have asked, what would you want to tell the private sector?
Welcome back. Looking good for a lot of the commodity stocks. We have Vedanta, which has moved to the high point of trade. Hindalco's been doing well as well. Even though the metal index did come off the highs earlier, now we're seeing some bit of pullback out there. JSW Steel, for instance, has moved too. What's also moving are a couple of these crude oil beneficiaries, so to say. We have all of them doing well in today's trading session. So while we talk about commodities, let's also get in Manisha to tell us the commodities that she's been tracking today. Manisha.
Thank you for that, Mangalam. I'm looking at the metal prices because we are looking at a smart rebound onto that one. The US dollar rally has paused, and that is one of the impetus that you have seen come into the prices. And then apart from that, reports on how Russia is withdrawing forces from some of the Ukraine cities also has led to some risk appetite coming back into the market. And then there are expectations of a stimulus coming in for China pretty soon, and that is yet another factor. If you look at the copper prices, we're trading at a 2-week highs onto this one. 660 is holding, even as we have seen a very minor decline come in for this one. The reason for copper prices being volatile is the Escondida mine in Chile, where there have been negotiations about the security measures there. We do understand that the union workers are still talking to regulators, and if the talk goes well, then you would be looking at production coming back. As of now, we do understand that there's a partial shutdown that we are looking at in Chile's Escondida mine there. Not just that, we are looking at aluminum and zinc prices continue to rise as well. The higher power prices, the power shortages that we are seeing in China and Europe clearly have been supportive. So the cost of production in these energy-intensive metals clearly seems to be on the higher side. And then you have the nickel prices, which have continued to gain on strong demand as well. It's trading very flat right now, but yesterday was nearly 3.5% of gains coming in for this one. Interestingly, even as we have seen a lot of sanctions come in for Russia, but the European Union and US have spared Russian metals for sanctions, and the numbers clearly show that. So when you look at the numbers there, the European Union aluminum imports from Russia are up by nearly 13% in the period of around March to June 2022. Not just that, when you look at the US imports as well, Russian nickel imports are up by 70%, and the European Union nickel imports are up by nearly 27% within the same period. So as you can see, when the sanctions started coming in, within that period, the imports of metals actually was on the higher side there. Take a look on what the prices clearly have done, and they have moved on the higher side for this week. Interestingly, before that, there also is a report that has come in from Vale, which says that the global nickel demand is seen 44% higher by 2030. The major demand clearly will come in from the EV sector and the metal transition as well. This is what the metals have done in the last 1 week itself. The best of the gains clearly coming in for nickel with 15% of gains there. Copper up 5%, steel, iron ore up by 3 to 3.5% as well. So good going for that sector.
Okay, all right. Thanks a lot for that, Manisha. Well, let's shift focus to a special segment where we get you a few ideas for profit from Money Control Pro. Bharat joins us to tell us about a stock he's tracking closely. Bharat? Welcome back. You're tuned in to Chartbusters here on CNBC-TV18. Well, Saturn Credit Care, that's the stock that we're tracking. How is growth panning out for the company? How are the collection efficiencies as well going on? And where's the asset quality headed? Well, to discuss that and more, we're joined by the chairman and MD of the company, Mr. H.P. Singh. Hi, Mr. Singh. You know, your stock was buzzing a couple of days ago, but that could be stock market dynamics. We wanted to understand what's going on with business. So on the disbursals front, if I look at Q1 on a consolidated basis, you disbursed close to around 1,700 crores. At pre-COVID levels, I think it was upwards of around 1,800 crores odd. So could you tell us, are you back to pre-COVID levels on disbursals? If you could give us a rough number, and also your collection efficiency, what's it at as we speak?
Yeah, so our disbursals are back to the pre-COVID levels of about 1,800 crores plus. And in terms of our collection efficiencies, we are again, somewhat at the levels where we were at pre-COVID, which is at about 97 to 98%. Disbursals which have happened in the last 1.5 years, our collection efficiencies are 99% plus. So we are back both in disbursements as well as the collection efficiency back to the normal days.
Right. Mr. Singh, I just wanted to understand the new guidelines that came in from the RBI in April 2022. We understand that, that's made life a little more difficult with regards to higher customer rate rejections coming in for you. Have you experienced the same? And in light of that, what's the kind of growth that you can guide for this year?
So I think, the regulations came on 1st of April, so post that, we've been able to do a disbursement of about 1,500 crores standalone in microfinance. Even with the rejection rates inching up from about 30% to about 35 to 40%, we've been able to maintain this growth momentum, and going forward, it's going to be there. The only thing is that what we have to do, we have to capture household incomes and everything across it, which is being done fairly now, basically. So the growth momentum will keep on happening in the next quarter as well.
Okay, and what does that mean then in terms of an AUM growth? If you're sounding reasonably optimistic for FY23, what are you guiding for?
So we're guiding for about a 20 to 25% growth for FY23.
Okay, and just wanted to understand a little more about these rejection rates increasing from 30 to 35 odd percent, 38 odd percent. Have you so far seen any sort of impact with regards to the asset quality with these rejection rates increasing? I mean, the ones that you've given the money to, have they been better quality assets? Can you give us a sense of what kind of credit cost do you guide for?
So technically what is happening is that borrowers who have been over leveraged will not get credit. So which that means that your credit quality is going to be better than what it used to be before after these new guidelines have come in. And credit costs, technically, we will not have any further credit costs in the future quarters. We've done about write-offs in the first quarter, so I think we'll maintain that. No further credit costs coming in our balance sheet.
What could you give us a number? What should the credit cost number look like for FY23?
I think overall for the whole year, I think it'll be close to about 4%, 4 to 5%. That's it. Yeah.
Okay. All right. What about your restructured book, sir? What is the absolute number of your restructured book? And also if you could give us a percentage of your total book.
So restructured book is down to about 11% in the June quarter. And it is going further down technically. So by the end of this quarter, I think we probably will not have any restructured book left. All would have either come off or we would have written it off from our balance sheet.
And what about the new investor that has come in? We've had Florentry, which is, of course, founded by the former Blackstone head. They invested about 100 crores in the company for a 12.35% sort of convertible stake. Just wanted to understand, how does life change for you with such a large investor coming in? Have they taken any steps to professionalize the board, asked for a couple of board seats, etc.? How has life changed, basically?
So life probably does not change much, with the investor coming in. I think, what we are getting is value-added inputs from the new investor. They don't have a board seat, but, for us, it is more of interaction from the experience which we can gain from the ex-Blackstone head. So I think, that is what is going to be credible for the company as such in the longer run.
Would you give us a sense on your housing finance subsidiary? I understand that there was some sort of mark-to-market done in a couple of your assets out there. In the first quarter, could you comment on that?
Yeah, so our housing subsidiary technically has an AUM of close to about 350 crores. And it's been profitable for the last 2 years as such, And for an early stage housing finance company to be profitable in the first 3 years of operation, I think, that speaks well of the revaluation which we've really looked at in the mark-to-value asset of the housing finance subsidiary. So I think it's taking that forward that we've been able to do that. And housing finance subsidiary of ours has got probably the best asset quality in terms of, if you look at the GNP, our GNP is just 0.03. in the housing finance subsidy, even during the pandemic. The pandemic had 100% collection efficiency for the housing finance subsidy. So that way, I think the mark-to-market values has been pretty good, for us.
Very quickly, what are the NIMs you're guiding for?
For the overall microfinance, or for
yes, overall.
For microfinance, we're looking at about close to about 10% odd, NIMs which is there.
Microfinance 10%, right?
Yeah, 10 to 11%.
Okay, thanks so much, Mr. Singh. Good speaking to you. Thanks so much for joining and giving us those details. We have run out of time on this show. You stay with us. Trading Hour comes up next.